Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. Here we are with our special series, the Fast 50, 6 days back-to-back of podcasting around the release of the Fast 50 report. This is our third instalment of this special series. We've launched a report a couple of days ago. We've spoken about what do you do, how do you use it, what's next yesterday. And today I really want to dig into the dollars. It's all about the money. It's absolutely all about the money. Someone that knows all about the money. He's been chasing sit-down money all his life. Largely still got only walking around money. Paul Glossop, CEO of Pure Property Investment. What's it mean to have sit-down money?
Mate, I'm going to throw that question back to you. You're the one with all the accusations. So tell me, what's the difference between sit-down money and walk-around money?
Folding money.
I'll tell you, this is a funny one for listeners. I've got a banker who we share, a similar banker, I think, in some of our stuff that we do in property, who's a private banker with NAB. I'll give him a shout-out because he's a good egg.
Mate, I don't know. Sorry, just to digress for a little bit. And he's going to know who I'm talking about. I'm sure the folk at NAB are going to know what I'm talking about. Mate, I've been so impressed by NAB.
Geez, listen to this.
No. I don't normally plug. I don't like normally plugging lenders. I normally enjoy giving lenders a hard time.
I'll keep giving them a hard time.
Yeah, you do that.
Yeah, right.
But I've got banking relationships with all the major banks and a lot of the mid-tier, second-tier banks. Even some lenders like Liberty, right, for certain sort of stuff. But I only recently moved over to do some banking with NAB, and I've now sort of moved about, maybe 7 loans with them. Mate, I've been impressed. They've been hugely responsive. And they feel as though they care and they're happy with me as a customer. Yeah. And I very rarely get that from a bank. So
hopefully that little endorsement gets you a little bit more credo and you can get a little bit more equity out.
I'm very conscious that I do this podcast. Hundreds of thousands of people listen to this podcast, right? And over the course of a year, a lot.
You're a sentiment builder or a destroyer.
You're talking probably, 2.4 million Australians invest in property in Australia, right? A lot of them,
10% of them.
A lot of them would be tuning into this, right? So I'm very conscious of this platform and this voice. And it's not very often. Being a journo, I normally like to go on the offensive because that's where it's most fun and enjoyable and watch this space, everyone. But on the flip side, I'll call it out when it's due. They've done a good job. All right. Very happy with them.
That's
anyway,
enough.
So thank you.
That's enough of that. Going back to the question, though.
It's all about the money.
Well, going back to the sit-down versus walk-around money. And this is the terminology that I got from this said shared banker. That's where I got it from. So I'll share a little story with the listeners. So I did a big refinance on a development that I took part in probably the best part of 2.5 years ago. And in part of that, the development went well. We sold a portion of the development, kept another portion, and as subsequent to the outcome, we ended up selling 2 assets, keeping 2 assets. The 2 remaining assets, by the profit of the first 2, was completely unencumbered. So we paid off 2 properties, got them essentially for free. Now, via the equity extraction, the conversation with my banker kind of went to the point where we went through all the documentation and he agreed to release X amount of money. And his language to me was saying, look, just so you know, when we sign this off, we usually don't go down this pathway, but we can see the rest of your portfolio. We can see that we trust where this money's going to go. But just so you're aware, this is what we deem to be walk-around money. Because once that money is released, it's yours. Now, yes, you pay interest on it, but you could disappear and that money's yours. You could extract it, turn it into cash, and all of a sudden you can live out the back of a Humpty and essentially just go and tour the world. That was the definition of walk-around money. I didn't get the definition of sit-down money from him, but I reckon you've probably got a relatively clear definition of that.
By the way, this is a podcast around the Fast 50 report, which you can download at smartpropertyinvestment.com.au. Where to put your money today for the best capital growth in 2025.
Walk-around money tomorrow.
Walk-around money. So we've given away a couple. We've given away 2 suburbs so far. So and everyone's getting annoyed. Going, just tell us where they are. Tell us where they are. Go and download the report. You'll find out we're all 50 of them. smartpropertyinvestment.com.au. But so walking around money it's just, you can do stuff with it.
It's your money.
Yeah.
You can walk around and do what you want.
Money.
It doesn't necessarily refer to an annuity. I think that's your difference. Sit down money is when you sit down, you don't have to do anything, the money keeps coming in.
Yeah, that's good.
That's your sit-down money.
Yeah.
Now, most people want a combination of walk-around money and sit-down money. If you get more sit-down money, you end up with walk-around money.
I find that people with sit-down money
You get it?
get edgy, and they like to turn it into walk-around money because they still want to.
Yeah, they want to transact.
So walk-around money is you're trading.
Yep.
Sit-down money is you're sitting. You're doing nothing.
It literally,
and it probably goes in cycles, right?
Absolutely.
I go through periods where I sort of go sit-down money, walk around. Where I just go, I don't want to do anything for a while. I'm consolidating. I'm going to sit down
money
and sit-down money. I reckon sit-down money's got to be like you don't have to do anything ever again money.
Yeah, absolutely. If you've got sit-down money, you choose to do something. Walk-around money, you may still have sit-down money, but you're dangerous.
And I think have we really done this?
We have. We can't undo it now. Yeah. But I think if it comes down to it, what I was trying to get from my banker at the time, what he was saying in no uncertain terms was, we're taking a risk by giving you this money because it's walk-around money.
Yeah, okay.
Yeah. Just don't do bad buys.
However, they've probably gone, well, there's a certain level of appropriateness and own self-regulated prudential attitudes towards money. So they had confidence to give you the walk-around money, right?
Pretty much. They deem it to be a sophisticated investor, will give you the walk-around money.
So most property investors need a little bit of walk-around money, right? Because walk-around money allows you to transact and trade.
Yep.
And in property investment, largely that means you've got enough money for a deposit.
Yep.
How do you raise a deposit? Well, typically you've either saved your money and you've got into your first property, or you've been able to get some sort of family guarantee to get some cash to do something else. Walk-around money, you can transact with it. Then you do something with it. And we spoke about last time we got together. This is a great report, really interesting information. It's only as good as what you choose to do with it. So we've been there, done that. But you want to start transacting. Now, the key point, and what I want to chat to you today about, Paul, when it comes to this Fast 50 report, is that this is geared towards capital growth, right? But capital growth doesn't happen in isolation. Capital growth happens over time.
Yep.
Now, what we've tried to identify with this report is where to put your money today for the best capital growth, right? So the speed of capital growth. And we're only looking at this with a 1 year horizon, but the inherent attitude is that there should be an inherent good quality suburb to hold property in the long term. And as you're holding property in the long term is where you get capital growth, right?
Correct.
But the important point is you've got to hold it, and to hold it means that you need dough. And how you're going to have money to manage your portfolio is absolutely critical.
Yep.
Property investment is great until you're forced to sell a property. Then property investment ain't so great.
Yep.
And we're in a cycle right now where a lot of people have gone from, interest rates that start with 2 to 6. A lot of people would have had positively geared portfolios, now have negatively geared portfolios. Mm-hmm. So if they want to hold their property in order to realise capital growth, you've got to feed the beast, right? You've got to feed it. And feeding it is with cash. And cash at the front end. And what we're talking about is the pre-tax management of cash flow for your portfolio, and that's absolutely critical. So cash flow does come into play when it comes to this particular report. We talk about, we include yield as part of our mechanisms and metrics for sorting the properties out. We started at nearing 200 properties. And when it comes to this particular report, I'll tell you exactly how much we had. It was 146. 146. So there's a lot to choose from, and we did use yield as a mechanism for identifying, of all these recommended properties, which ones were the top 50. And if they didn't make top 50, it doesn't mean they're not a good suburb to invest in either, and we'll get into that as well. But there is a cash component as part of this. Money talks.
Yep.
Absolutely, money talks. And you've probably got some scenarios there where you can give us some sense for, a lot of people chase capital growth. That's how you create wealth through property.
Yeah.
But sometimes, and much like this report, some of these suburbs might not be right for people because they don't provide the cash to sustain the holding of the portfolio, depending on where they are in their investment journey.
Absolutely, Phil. And I think one thing we can probably do for the listeners for this episode is probably pluck out a couple of different suburbs in this report that they can download right now and essentially run through, okay, well, the scenario A, I can maybe afford a slightly higher price point. Scenario B, there's an option for me to then jump into a lower price point. There might be a higher and lower yield. Now, obviously the brass tacks of it is that if you've got an $800,000 property that grows at 15% this year, and you've got a $5,000 property that grows at 15% this year, the actual gross growth from both those assets whilst the actual percentage is the same, the dollar value is obviously dramatically different. Now, if you can afford to go higher, sometimes there's an argument to say, look, even if the cash flow is slightly less, your actual net return will be greater, even if you get exactly the same growth outcome. But the cash flow is obviously, if the yield's lower, the income that you're going to get from that property will be lower. So then it comes down to a conversation, can you afford to hold this property over the next 2 years, 4 years, 8 years, 10 years to not just get a 12-month outcome, but to get a 10-year outcome? So I'm going to pluck out 2 suburbs from this report to give the average purchase price that is right now, and I'm going to put some expected growth, and I'll put some hypothetical growth.
Before you do that,
sure.
I want to give our listeners tuning into this some sense for the bookends of this particular report. So in terms of the value, so the point is that not all suburbs are created equal, and different suburbs will be right for different investors. Many of the suburbs in the Fast 50 report at the moment will be outside of the capability of a lot of investors.
Yep.
They purely don't have the purchasing power to buy them. In time, if they invest well over time, they may be able to shift up brackets into different types of properties, and we've all done that. I remember my investing journey and yours, which are largely in parallel, buying similar places at the similar time. They started out in the western suburbs of Sydney, right? Mm-hmm. In areas where a lot of people were still going, why would you invest in those areas for? When you're able to get into the market for sub a couple of $100,000 or sub $250,000 for houses. So, can you get properties at that price point today? Unlikely, but comparatively, there is still suburbs like that. So when you look at the Fast 50 report, and these are the suburbs that are in there that have made the list, Medina, 6167 Paul in Western Australia. And by the way, a lot of these suburbs I've never heard of before, right? And that gives you some sense for the depth at which we've uncovered. 10,000 suburbs in Australia, right? So a lot of these, most of them I haven't heard of, to be honest with you. The only reason why I know of some of them is because they were in last year's report. Median price there, $337,000. So if you have a full-time job in Australia and you're sensible with your money and you don't overspend and you don't take on the wrong types of debt and you live within your means and you're quite smart about what you eat and you're able to save, you could probably get into that market. I'm generalising, but $337,000 is an accessible price point for a lot of people.
And if I give people sort of what the sense of what you need to get into that type of market would be, if you talk about deposit, closing costs, etc.
And there's 2 things. If you're a first-time investor,
with nothing to
nothing
grab,
at all.
no equity, no guarantor loans, no nothing. For that type of property with 10% deposit, stamp duty, all standard closing costs that we'd factor in, about $65,000 would get you there.
10%. So you're in for about $30,000 in.
After all said and done, it's about, once you factor in, and I'm factoring, I've got a live spreadsheet in front of me, I'm factoring in stamp duty, legals, I'm factoring in a buyer's agent fee, I'm factoring in a building inspection.
Can you just break that down? So 10%, so it's $33,000 for the deposit, right?
Yep.
That's a given. What else is there?
So you've got estimated stamp duty on that purchase is about 13 odd grand.
Okay, that goes to the Western Australian government?
In that instance, it would, yes.
Yep.
You've got legals, I'm factoring in $2,000.
Yep.
I've got buyer's agent fee, I'm factoring in $15,000.
Yep.
I've got building inspection, I'm factoring in $700. So I'm factoring in all said and done, just short of $65,000 to get into that purchase.
That's a big chunk of money.
It is a big chunk of money.
It's a big chunk of money. To be able to save up $60,000 is going to take you some time.
Absolutely.
It's going to take you some time. And for our younger investors, and that's at 10%, right? So
that's at 10%.
At 10% also, you need to be employed in a particular type of way, to access higher LVR loan products, that young professionals, couples and stuff, they should be able to sort out their financing around that pretty well. But 60K is 60K, but there's other ways you can get that 60K. There's a whole bunch of things. I did a podcast recently with Eva over at Finney Mortgages, and we spoke specifically about this, extracting equity, right? Like, you might already have properties that you can extract equity from, and we've done that strategy that I've used for many years investing in property. But if you're new and you've saved half of that deposit, you can tap your parents on the shoulder for the other 30 or 40K, right? Yeah. To get going as a pledge, right? And that's going to get you started. So at the bottom of the market, that's $337,000.
Yep.
This Medina, the suburb, 2.7% quarterly growth. You're getting 3.8 average annual growth. So that's what it's been averaging over the last 10 years. You're getting 10.5% 12-month growth, so it's obviously in its ascendancy. You're getting a yield of 6.5%, which is pretty good because the rent is $420, right? So the holding costs for this property, again, we're talking about cash. So cash being king, as in being an enabler to hold your property so you can get capital growth over time on the basis that the Fast 50 report says here's some good suburbs to get going with. How far off positively geared would that be?
Well, I've got I use that same live spreadsheet. So in the instance, if you had a 10% deposit and you're paying an interest rate of 6.5%, which is about there or thereabouts right now. And again, that's today's money. The reality is you might be able to fast forward 18 months and forecast, say, you might factor in 0.5, 0.75 reduction in that. But let's use today's money. So 6.5% interest rate, interest only at $420 a week. And again, I'm going to walk through. So I'm factoring in council rates of $2,400 a year.
So was this suburb was the one you got to talk about, was it?
Well, yeah,
That's
absolutely.
handy.
Yeah,
Okay,
so I've got
cool.
it up live in front of me. So council rates, I'll estimate $2,400 a year council rates. You pay that as an investor. Water rates, $1,400 a year. You pay that, probably a bit less, but I'll factor in you'll pay the wedge of it. A lot of the time you can charge water usage to your tenants, but I'll say $1,400 a year. Management fees, property management between 8 and 12%, depending on where you're buying. I'm going to factor that in.
WA is expensive.
WA is expensive. I'm factoring in about $2,000 a year, give or take. I've got your mortgage repayments on that property are just shy of $20,000, so $19,714. I've got building insurance, landlord's insurance of about $1,400 a year on that purchase. On $420 a week rent, that property is going to be negative by $4,875 per year, $406 a month, $93 a week. Okay. So here's the deal. So you say, okay, well, it's costing me $93. Is that justifiable? So there's two things that come out of that for me if I'm a first-time investor. Can I afford to go backwards?
Pre-tax.
Pre-tax. So obviously post-tax for those, and I don't want to get too deep into it, but post-tax will likely be better because there will be some negative gearing benefits. Exactly. Yeah. But this will be worst-case scenario. Obviously, this doesn't factor into account a couple of things like repairs or vacancy. Yeah. You might have different things you want to chuck in there, but let's just assume that it's rented for the entire 52 weeks and also you don't have anything that comes up other than what I've just mentioned there. $93 a week is what you have to stump up in this instance in those raw numbers. Now, out of that, you just noted that, Phil, that it grew by, the suburb of Medina grew by close to 11% in the last 12 months.
10.5.
10.5%. So if you bought for $337,000 and you got 10.5% capital growth.
Yeah, it's 30-something grand.
You're getting about 37 grand in growth in that year. Now, if we go back to $37,000 over an annual period, so $37,000 divided by 52 weeks, that's $711 per week. That property's gone up in value. It's cost you $93 to make $711.
So what's 93 divided by 711?
93 divided by 711 is essentially 0.13 times 100. So you get 13%.
Yep. So it's costing you 13% of what you're gaining, you're giving away in order to get that.
Essentially, 1 in 10. So essentially you're effectively making 10 to 1 on your money. If it's costing you $93 a week to hold, in that instance, you're essentially making a bet that's going to make you 10 to 1 on your money.
Yeah, which I reckon and it's largely guaranteed.
Well, yeah. I mean, look,
unless something catastrophic
there's
happens.
Variables, but I would probably even go further to say that there is upside that is not factored into two big factors that would likely play out in the next 24 months. First of which is that I'm factoring in 6.5% interest only. If I change those numbers, and let's fast forward 24 months, and let's say it goes down to 5.75% interest only, all of a sudden that goes from that $4,000 a year to $2,601 a year, so $49 a week.
So it halves you.
Halves you. Now, the other thing that's happening in markets such as Medina, you've probably got around about 12% rental growth in the last 12 months. So let's say in the next 12 months or 24 months, which I'm just factoring in, let's say it halves and it goes to another 10% rental growth. So 420 plus another 10% will give you a total rent of $462 a week on average. So if I factor in those two things, $462 a week, and we've dropped down our interest to 5.75%, all of a sudden now this property pre-tax in 24 months' time would cost you $11 a week to hold. So basically neutral.
That's a chicken sandwich.
Well, that's a cheap chicken sandwich wherever you're buying it from. Maybe 2 days old.
Not
the special rack at Coles. But I think what I'm trying to articulate there is a very clear part that we all know as property investors, Phil, you and I, is that the hardest time to buy and hold property is typically your first 1, 2, 3, 4 years because Your LVR is the highest, your rent is the lowest it'll be. And in this environment right now, we're probably at the top end of what this interest rate cycle will be for the next few years at least. So if you can afford that $93 a week in that instance, your headwinds that you're facing are probably going to be the strongest right now. They'll actually ease back. And the other thing that happens, if you get that capital growth, like we just talked about, you're making 37 grand and you're spending the best part of 4.5 grand to make 37 grand. If someone gave you that as far as an opportunity to invest, would you take it? I'd probably say 99 times out of 100.
And what Paul's done
yes.
there on the fly in action is what property investment is.
Absolutely.
Like, property investment isn't sexy. Property investment should be boring. Property investment should be easy to understand. And property investment should be accessible to most Australians if they are sensible and smart and approach it in the right way. When property investment goes wrong is largely when all those things don't happen.
Yeah.
When you don't understand it, it doesn't stack up, it's too good to be true. Let property investment be boring. Now, this is at the lower end of the market, $337,000.
Yep.
There's not many places in Australia now you get picking up houses for this, right? But it's a moment in time for Western Australia.
It is
a moment in time for Western Australia, which has been a bit humdrum over the last decade. I doubt that price has changed much over the last 10 years. It's been growing at 3%, right? 3.8%. So that's how it works. So can you, if you're new to property investment, are you able to get 60 grand together? This is simple. Can you get 60 grand together? Yes or no? Yes. And I've given you some ways you can do that. Clubbing your money, co-invest with someone, tap on your parents on the shoulder, get a big bonus from work, whatever it is. Can you get yourself 60 grand? And can you reduce your spending by $93 a week, which is a night on the beers, it's an Uber Eats, it's I don't know what else it's like.
It's a choice.
It's less than a bag of groceries.
It is.
Don't eat for a day.
Don't advocate that.
Forage.
Forage.
Mate, be a dumpster diver. Be a dumpster diver. We've all
and if anyone
done it.
doesn't know what a dumpster diver is, I'm happy for you to send Phil a private email. He will articulate that specifically.
But most people can curb their spending for $93, right? Like, just don't go out one Saturday night, really.
Yep.
And this is it. It's property investment is accessible to most Australians.
Yep.
And we see it now. We hear it now. And just get political for a moment. You have certain areas of the political class right now are banging their drums talking about property investment and how it's stopping Australians from buying property. Property investment, evil property investors who are gouging the Australian taxpayer by getting tax breaks. You're hearing it mainly from the Greens who are trying to become
ill-informed, in my opinion.
They're trying to become the party for renters rather than their traditional backyard, which is the environment and climate change, which they've tried and haven't really got too far on. Not noting, I think they're very important issues. But they're going, property investors are stopping Australians from investing in property. You can do that yourself as an owner occupier.
Absolutely.
$337,000.
Do the same math.
Do the same math.
Just don't have the rental income. There's nothing stopping you from doing it. You just have to figure out. I mean, their argument might be that you're inflating property. I've got a completely 180 view of that. Is that the government's intentionally or unintentionally via red tape is the one word is supply. And hot tip, you can make supply available. And I can tell you right now, in New South Wales, you've got huge amounts of proposed reform to density. I own personally a couple of properties that I know of that will benefit from these density changes. You know what it does for those properties for me, Phil? Nothing. And you know why? Because the cost of construction is exponentially too high to justify going from a 2-story building to a 6-story building. There is no return.
At the moment.
And you could say, okay, great, you've gone from an R2 to an R4 site. Does that change the value of the property? Maybe for someone who's happy to bank for 10 years on that land. Would I then go all of a sudden go to the bank and say, hey, I want XYZ because I'm going to go from a duplex site to 18 apartments? No, because the sale price is less, the construction cost is higher, the red tape is insanely more detailed, and the return is not there. So good luck with that.
There's a lot of I work in a business of information in a range of different ways across a range of different areas. Now, one of the biggest issues we have around information is misinformation, right? So very simple terms, you have misinformation and disinformation. Disinformation is deliberate information, intentional, which is wrong. misinformation is people consuming information and assuming it is factual and sharing it, and it's misinformed.
Yep.
I think there's a lot of misinformation inside of property. Now, the issue we have, and just staying political for one moment, looking at these numbers here on median prices, is that we have this thing called the Canberra bubble, right? And this is the political class that operate in and around Canberra. Many politicians, not most, but a lot of politicians and their staffers are career politicians. They live in a certain... We've spoken about sort of perception and perspective, right? The perception of the world is based on what they know, and the best politicians I know are able to step outside of that and get a perspective of what everyone else feels like. A lot of the information now coming out of property markets, the Wall's property market, is biased, right? It's assuming inner city people living in areas. Now, I'm looking at the Fast 50 report right now. There's 5 suburbs. You can invest in Australia, for the Fast 50, under $400,000. There is 24 suburbs of the Fast 50 under $500,000. So half of the Fast 50 is under $500,000. And you gave us some numbers there around the cash required to get into the market. 400 grand for 500 grand. A little bit more, right? You have to save a bit more. You're going to have to access a bit more dough, right? Then you've got another, 6 properties, 6 suburbs in the 500 grand bracket. There's 4 in the 600 grand bracket. There's 5 in the 800 grand bracket. There's 2 in the 900 grand bracket. There's 3 in the $1 million bracket. There's 1 in the $2 million bracket. Yep. I think what happens with a lot of the commentary around property, around changes to the tax regime, and how many wealthy Australians are benefiting from property, most property investors are probably investing in suburbs under $500,000, at least to start with, right?
Absolutely.
They're not wealthy Australians. They're middle of the road, average Australians that probably sit within the tax bracket, stage 2 tax bracket.
Yep.
And this is where it gets all wrapped up and wrong. So to the point is, with property investment, it's horses for courses. There's going to be certain properties that are going to suit certain people. You know, to start investing in properties with a $2 million price tag, Paul, the economics of that are going to be very, very different when it comes to cash. And we're talking about cash. Cash being the vehicle for holding your portfolio so you get the benefits of capital growth. It's as simple as that. Hold your property for as long as you can in a good market and you'll get capital growth. And I'll tell you what, Paul, and it's not covered enough when discussions around property taxes happen, all of these property investors who make money through investing in property, number one, they're providing rental accommodation for the Australians that can't access the market yet or they're waiting in the market. So number one, there's a really good social benefit from it. The other big social benefit from these people ain't got their noses in the trough of the government coffers at retirement. That's good for Australia. No one's talking about this stuff. So again, it comes down to how do you hold your property? It comes down to cash. What would numbers be at the top end of the market?
Well, Matt, if we looked at not even go all the way to the top end, and let's say we took one of those suburbs. It was a Brisbane suburb, Marumba Downs, as an example. Okay. Right now, you've got average price about $795,000, and you've got average rent of about $580 a week on that same property.
So this is like probably a bracket where
middle ring.
Property investor who's been at it, probably got a few properties, are going to start trading up into.
Yeah, trading up into want maybe slightly more quality, slightly less quantity, and maybe looking at more value. Now, if I take the same numbers that we assessed from the WA property that we just did the math on, which was $337,000 purchase price, much lower price point, and we estimated about 10.5, 11% average annual growth. Now, I'm going to do the numbers with exactly the same expectations in mind. So 10% deposit plus, so we go through, break that down. So 10% deposit, $79,000 or $79,500. Again, the same thing. Well, stamp duty will be $31,000. Again, that's a tax that the government gets, just so you're aware. Anyone who wants to play political here, that's a tax.
That's good money.
Yeah, it's good money. And hence why, that's a ridiculous tax, but it's a tax.
Property investors are one of the greater contributors to the government coffers with tax at the state level at least and local level than most other areas.
Absolutely. Of
Often
course.
forgotten.
Of course. And obviously if that stops, then that revenue stops. Hence why this is not going to be tinkered.
I think we should do a podcast just on this, just in general. But anyway.
Absolutely.
I don't want to get too political.
We can get a lot deeper in there.
But we are for property investors.
Estimated legals $2,000. I'm going to say all these things are the same. Estimated buyer's agent $15,000. Estimated building and pest $700. $129,000 for that same property, 10% deposit, same all closing costs. So you're essentially going to double what you're required to put into for that $337,000 property. Now, if we work off the same expectation, 6.5% interest only on this particular purchase, as far as the the mortgage repayments, $580 a week. This is where things start to become a lot more real, and you start to ask the government that you're speaking of here, is that all greedy property investors? I'll start run through some numbers. Let's assume
the Prime Minister now is called the property investor Prime Minister, is what the Greens are labelling him as.
I like it, mate, because to be honest, I'm not going to go too deep into this, but I've met Albo a couple of times personally, probably 4 or 5 years ago at different events, well before he was even close to running for PM. And I'll tell you what, I was sitting in a council chambers in Campbelltown, southwest Sydney. And if someone does want to get out there and see, look and feel, I'll tell you what, that man did a fair bit of it. But, yes, he's pro.
I didn't know you're an Albo fan.
But I'm not going to suggest that I am, because to be honest
but
with you, I'm not.
As a person, he's given a crack.
As a person, I've got no issues, mate. But I am adverse to things like what the Greens have come out with. And I'm not adverse to what the Greens' policies are on a range of things personally. But when it comes down to just blanket ridiculous policy on housing, which just tries to canvass everything with the same rubbish brush that they've got at the moment, it's frustrating to say the least. Anyway, council rates $2,400, water rates $1,400, property management fees about $2,500, mortgage repayment on that property there at that price is about $46,000 a year, interest only 6.5%. Your building insurance, landlord's insurance, $1,400 a year, same thing. Now, I'm going to leave it all the same. The negative cash flow on that property at $580 a week works out to about $24,000 negative. That's a lot of money. And we break it down monthly, that's $2,000. Weekly, that's $460. Yeah, that's a lot of money that someone has to stump up and figure out where do they get $460 a week from.
At the moment.
In that point in time from day one. Now, that is a shortfall. But if we work through then, and this is where I'm saying I'm not all for yield, and the reason why we don't focus just on yield, because if you can afford, remembering this is pre-tax, and if you're on a higher tax bracket, and you can say, okay, great, look, I'm on $200,000 a year. I can reduce my taxable income by $24,000 a year in that instance. All of a sudden, I'm probably going to get back conservatively 30% of that $24,000. That's about $8,000.
And that's the negative gearing that the Greens are saying is stealing from the government.
Yeah,
coffers.
correct. So in that event, I'm still negative $16,000, but I'm stealing $8,000 from the public, apparently, in that instance, because I'm getting $8,000
But you're
back.
providing housing.
But I'm providing housing for someone in that middle ring bracket right there. Now, I guess where the advantage is for an investor, if you can afford to buy that asset and you want to move into that middle ring, less quantity, more quality type of asset, and you still got that 11%, 11% growth, and again, working off exactly the same prediction of that lower price property, $795,000 in year one, that's about $87,000 in growth in that 12 months. Now, again, going back to that, what have you given away? You've given away $24,000 to make $87,000. So the net return on that purchase is greater than the net return on the lower price purchase, even though the cash out was for $4,800 versus $24,000. But again, this goes back to saying one might be right for one, where one might be right for the other. And you've got to know, you've got to crunch those numbers before you go into these markets. And I'm a huge advocate personally, as a buyer's agent property strategist, what we don't want to do is push people into buying 2 properties at $400,000 when they could afford one quality property at $800,000. That's going to get them there, potentially same pace, if not quicker. But it's not the same outcome for everyone.
Yeah. And so in simple terms, the cost to hold is higher at a dollars term.
Yep.
The upside is higher at a aggregate level, but it's all comparative.
It is comparative, because you could also have just bought 2 properties at that lower price and actually got a better cash return and also a better net income return. But you also got to factor in, you've got double the hassle, you've got double the set of everything. You've also potentially got 2 properties in one market, so diversification's not taken care of. There's a range of other things which you could consider there.
Yeah.
But I guess what we're trying to elicit is, hey, there's 2 examples. One's at a higher price, higher cash flow, total net return's better. you can compare the pair and say, well, you might have a preference depending on your position where you're starting from. This does start to make you scratch your head and think, oh, yeah, I don't just want two really cheap properties. Maybe I want one higher price. Or conversely, I'm probably not necessarily that comfortable. Even though I can hold 24 grand negative a year, I'm probably more comfortable thinking two at a lower price with far less risk is probably going to fit my risk profile better.
And for our listeners out there, the point to take from this is that at the moment, depending where you are in your property investment journey, you may be only able to be buying those properties in that $300,000 and $400,000 price point. That's okay.
Yep.
There is good assets in that bracket.
Yep.
For other people, depending on your circumstances and what you earn and what you've done beforehand, you may be able to play in different brackets. And there's largely the mechanics are the same. The dynamics is what's different. Do you have capacity to hold higher value property in a market where interest rates are much higher than what they have been before? To run those same numbers back when interest rates were probably 2.5%, be very, very different.
Well, I'll give it to you now.
That's
Phil.
Maroomba Downs, exactly the same dynamics.
Exactly the same. That positive that property that was negative 24,000 is positive $4,800. Exactly the same dynamics.
And that's just interest rates. So
That's
things
just
change.
interest rates.
What you're guaranteed in property investment is change, right?
Yep.
So you're probably running those numbers at the top of the market, and you've got to be able to have the confidence that you can find in cash $24,000 a year, 500 grand.
Buffers.
All that
you
sort
could
of stuff.
be vacancy. There could be running repairs in addition to that, etc.
And this is the risk and reward. But only like that part of that is negatively geared. Not all of it is negatively geared.
No.
You get whatever your tax bracket is, right?
Correct.
Back on it. And again, that sort of cascades. So this is the dynamics of property investment. And the important point is, if you buy the right properties in the right locations, you're going to have to hold on to them. So you've got to have cash central to all of your calculations and know that you've got an appetite and or the bandwidth for negative cash flow, and that will help set your strategy and your price points alongside your buyer's agent. The point is, and it's a question for you, two questions. Some buyer's agents only operate in certain markets. They go, we only buy sub $400,000 stuff. Some buyer's agents go, we think that's bad. We'll only buy stuff in the millions of dollars, right? Do you do all of it? Do you
100%.
Okay.
And I think to your exact point, mate, these examples, your position now versus your position 10 years ago is another classic example. Your investment journey's changed, and our intention and our objectives, our buyer's agent specificity varies. We've got some of our buyer's agents specialise in sub $500,000 markets. We've got work. I'm working on a site right now for a client who I know has got an unencumbered $25 million asset, and we're looking for probably 2 development sites in the Sydney market that are going to be both probably north of $4 million, and we've got a whole range of other focuses in between. So, yes, in short, that's exactly what we do. Okay,
and that's important, right? Because I guess you want longevity or continuity of the buyer's agent going, okay, they're no good for me no more because I'm not buying $300,000 properties. I probably should do. We spoke about this in the last podcast. Maybe grabbing someone. I might revisit that back in my self-managed super fund. The second point is, though, and you sort of touched on it, when you run through those numbers, your buyer's agent fee was the same.
That's exactly right.
For a $330,000 property versus a $800,000 property. Double barrel question. Number one, is that fair? And number two, wouldn't you be better off buying 2 properties at the cheaper and say you get 2 buyer's agents fee? You must get that question all the time.
Yeah, but I try to circumvent that question a lot.
Not to put you on the spot.
No, but I like the question because I have this actual conversation with clients on a multi-time daily basis. And I guess when it comes down to it, mate, our job, in essence, is to get the best outcome possible to spend the least amount of money we have to. And I'm not an advocate, and I've said it a few times before you've even brought this up, mate. I'm not an advocate. If you had capacity to buy 2 assets at 400 grand or 1 asset at 800 grand, I can guarantee you this is that I'm going to, typically when you can afford a bit higher, it means you've got slightly higher disposable income, you've got a better cash position, better savings position. It'd be extremely rare that I would advocate buying 2 assets versus 1. Yeah. Now, very simply, obviously, I'll talk myself out of business by doing that. We charge a flat fee, and for anyone out there who's thinking about engaging a buyer's agent, and I'm not going to accuse buyer's agents necessarily on their fee structures, etc., but I know full well that buying a $1.2 million property or a $600,000 property or a $400,000 property For us, the work, the outcomes, and what we do in between is identical. So I can't justify what it comes down to. I know what it costs to get the outcome from a business perspective, and that's what we charge. For us, a percentage only means that, to be honest with you, Phil, we might be incentivized to buy a more expensive property if it was a percentage, or if we're potentially charging a flat fee, do we try to recommend buying multiple smaller properties because we're going to make more of a fee out of it?
So one of the arguments for and against using a buyer's agent, you go like 15 grand is what you
15
charge?
grand.
Yeah. It really hasn't changed that much over the years. Like,
No.
I remember when it's a lot more than when I started out. 15 grand on a $400,000 purchase as a percentage to 15 grand on $800,000 is very, very different. Now, your argument is the same amount of work goes into it, but a lot of the for and against discussion around using a buyer's agent, and it's all about conserving cash. Like cash
absolutely.
is all part of it, right? Is that you want to drive the price down as much as possible.
Exactly.
You're not incentivized to keep the price high.
No.
And that's a key point. But this whole idea of securing stuff under market value, well, you bought it for what it's worth. It's a really hard thing to quantify sometimes. Yeah, but a lot of people still use that as a mechanism for, hey, we're being able
Justify
to buy
the
under
fee.
whatever, right?
Yeah.
Like, give me a sense of that. How do you view it?
Look, we talk about this, I mean, so much, and under market value, I don't talk about under market value as a vernacular at all, because to you, what you've just said is exactly right, Phil. What you pay is market value. Now, you could set a new market value by paying under, and like it or lump it, once you buy a property, typically it's going to register on the portals, whether you bought it on market, pre-market, off market. It's still going to register. It's very hard for a property not to register on RP data once it's settled and someone else know what you paid for that property, unless you go through some different ways to make sure it's hidden.
Yeah.
Now, the reality is for us is that, look, the cost that we have, and I know full well where the value in what we do is to what we talked about as a couple of examples there. Our job's to try and find markets and opportunities within markets that we know are going to allow our clients to get better than average results and do the work that they would otherwise have to do without making mistakes. It's as simple as that. I mean, Phil, you talked about your antique 30-year-old vehicle. I could ask you how many of those 4 engines you put in yourself. That's a question. Answer is 0.
I put 1 in.
Okay, how'd that go?
I did it with a mechanic friend of mine. And there was a few leftover pieces.
I put them in the back for good
the head
keeping.
gasket blew 6 months later. So,
My point is that you do it yourself. The chances are there's going to be some things you'll miss out, and not to mention the time that it takes. Now, well, I'm not talking about replacing a head gasket.
By the way, there's nothing more satisfying than putting a donk in your own car.
And there's nothing more frustrating than driving down a country road and seeing your head gasket blow through your front windshield. But I guess what I'm getting at is exactly that. Here we are, is that you DIY, you get DIY outcomes. Unless you do, I mean, it's like any vocation, right? We do this thousands of times, and we have bought literally over 2,500 properties. You get pretty good at it.
Whenever if all you do is conveyancing, you get very
good at it. and mate, when all you do is buy property, you get really good at it. And I can attest to the fact that we buy a lot of property, and we're really good at it. If we're going to buy under market value, yeah, sure. Look, we're trying to buy as cheap as possible. And to your point, Phil, we have no intention of paying more because it's not a good outcome for us. And I want to catch up with my client in 12 months' time and say, you know, when we bought that property for $337,000, it's now worth $420,000. Yeah. You balked at it. Here we are.
Well, and we're going to chat about it a little bit later around tactics, but just to telegraph that a little bit, people get, and we'll close on this. It's quite a long one, but podcast. Buying under market value is a bit of a misnomer, right?
I agree.
But using a report like this, now we're speaking about cash and holding property and stuff, but using a report like this, you know, you look at the suburb we'll chat about there, Medina, and I'll give some other properties in that sub $400,000 median price range for the purpose of report, because I know people want that. Remember, go and download a report, smartpropertyinvestment.com.au. Armidale, which I'm familiar with, Callista, which I've never heard of before, and Aurelia, which I'm familiar with because it's in last year's report, right? Like you got there's and also Parmelia and Bauga, right? They're all sort of sub 400 sub 400, right?
Yep.
You know, these are accessible properties that you can get into. I can't remember what I was going to fucking say now. Hang on a sec. So how do you start again? So how do you use this report? We'll talk about tactics a little bit later on. We've told you what the median price is in Medina, right? You go there right now, you look at what's sold in Medina, right? And you go, okay, well, that's a little bit more than the median, right? So if I use this report going, okay, this is a good suburb to invest in and it sort of suits my profile as a property investor, I know what an asset can be worth in that suburb based on what recent sales are. So if I'm able to see something, might not get it cheap, but it has upside. So I might be able to get something, spend 10 grand on it, 20 grand on it to get the uplift to where other properties are selling. And this is the whole idea of like under market value properties, you need to realise some mechanical change to it in order to realise its inherent potential. And that's like by doing a reno.
Yeah.
How do you spend 10, 20 grand on it to get you to a product which is equivalent to what other things are selling for?
Yeah.
That's how you can use reports like this.
Absolutely. And if I do something even more simple than that, Phil, and I'll use Armadale as another market, I personally bought a property in that market. Now, I can guarantee you one thing, is that the average price, whilst it's saying it's circa in the 300s for Armadale, you're going to be hard-pressed to find anything that's selling under that at this stage. But I bought a property in my SMSF last year for well above that in Armadale. I paid well above the market value or the median in that market, but I bought a larger block with a wider frontage, which I knew based on the zoning. And I let my buyer's agent team do it, by the way. I didn't do it. They came to me with a property that had property at the front, to the left of the block, side access, opportunity for 1 into 3 lot subdivision whilst retaining the house. Paid well above market median, still renting for close to 6% yield. Yep. But I know inherently I bought more land than I did buy property. And there in turn has meant that the actual growth in less than 12 months' time has been exponentially higher than the suburb median, because the land is obviously, as we know, is what grows in value more than anything else.
So that gives you optionality.
It gives you optionality. So what I'm trying to get at here is that what a buyer's agent does is we're not just trying to say, hey, we've found the suburb, let's buy every property available in this suburb. It's say that property versus that property. Yes, the prices might be the same, but we still have to dig deeper. We have to know the zoning. We have to know the frontage. We have to know school catchment. We have to know walking distance. Arrange these other things, then digging into comparables to say, don't just compare that property with this property because they're the same price. You need to then compare land size, zoning, bushfire overlays in Perth is another big one. Certain things will restrict, certain things will allow. There's all these additional details that we have to go into when looking at the comparables, looking at price, looking at what we should and shouldn't be paying for a particular property.
There you go. That's the secret. That's the art. That's the science of property investing. Paul, that's quite a long podcast. I think we covered a lot there. It's good.
Yeah, mate.
Cash.
More to unfold.
Cash. Sit down money.
Sit down. We did spend a bit of time. Apologies to listeners, but hopefully they got educated in the difference between sit down and walk around money.
What's before walk around money? No money.
No.
Some money.
Well, that's we'll think about that for the next podcast.
We've got to go speak to this banker.
We'll get him on.
You know what? He'd probably come and have a chat with us.
He would 100%.
I'm going to catch up with him next week.
And we can talk about
actually.
the value and private banking and potentially where and where not to. It's probably not a bad topic.
Yeah, I was always sort of private banking, but I sort of spoke about it. They've done a good job. All right. Let's sign off. Fast 50 report, where to put your money today for the best capital growth in 2025. Smartpropertyinvestment.com.au is where you'll find it. Go and check it out. Stay with us. We'll be back. We've got 3 more podcasts for this special series on the Fast 50 for this year. Stay with us. I hope you're enjoying it. Any questions at all, don't come and talk to me because I don't know what I'm talking about. You're happy to field questions.
Yeah, they can email me, inquiry, ENQUIRY, at purepropertyinvestment.com, or they can just go to purepropertyinvestment.com. They can book in time to speak with me, 1300 98 5428, any of those 3 ways.
Cool. And comments for our team, editor at smartpropertyinvestment.com. If you want to give Paul a hard time, I'm happy to receive them. I'll pass them on any chance I get as he embarks on his mission for sit-down money. We'll see you next time.
It's not my mission.
Your mission is co-mission. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.